Hello everybody, welcome back. Thanks for joining me. I am here today with Jesse Hamilton of Pioneer Title Company, and he is the Senior Vice President and General Counsel here at Pioneer Title. And he's going to talk to us about 1031 exchanges and perhaps some other things as well. So thank you so much, Jesse, for giving me your time to chat about these things. So as you can see the sign here, it says 1031. What is a 1031 exchange? Maybe talk a little bit about that.
You bet. Thanks for the intro, Ben. I appreciate it. So a 1031 exchange is a section of the revenue code. And what it says is if you sell property that has appreciated in value and it's held for investment purposes or trade or business purposes, you can elect to defer payment of tax. We're not excluding anything. We're just kicking the can down the road. We're deferring it to a later date, so long as you buy other property that's held for investment purposes or used in a trade or business. That's how the code defines it. Here's how I like to explain to my clients and realtors how to think about it. You can 1031 exchange out of and into any interest in real property other than a primary residence and a second home. So if it's for your own personal use and enjoyment, it's not going to qualify. And there's some caveats there. I mean, if somebody lives in a duplex and they rent out the other unit, that's kind of a dual-natured property, right? It's partially your primary residence and partially a rental property. So when you sell it, we just kind of allocate value of what percentage is held for investment purposes and what percentage is your primary residence. But in a general sense, that's all a 1031 exchange is you're selling highly appreciated property, or it also could be property that you've declared a lot of depreciation off of. You've accumulated a lot of depreciation and you don't want to pay what's called a recapture tax. So instead you do a 1031 exchange and you roll your original investment plus your gain into a replacement property. And it can be any type of real estate you want, so long as it's not your primary residence or your second home.
And so it's a deferment, right? You're at one point you're going to pay tax on it. So I heard somebody refer to it as swap till you drop.
Correct.
Is that right?
Well,
is there ever a time when you wouldn't have to pay capital gains tax?
Not necessarily, no. Let me get back to it. Most of my clients, when they do exchanges, they always hold it as investment property. So when they sell a rental, they buy maybe a bigger rental, or maybe it's a fourplex or an eightplex, right? They just get a little bigger as they go. But ultimately, they continue to hold property because they like the income it generates, just passive rental income. It's a quality of life for them. But when they die, the benefit right now as the tax code is drafted is you get a step-up in basis. So when you die, all that accumulated gain that you have not paid tax on and all the depreciation that you've not had to recapture is actually forgiven upon your death. So that's why it's swap till you drop, 1031 until you die.
And so the trick then would be to inherit a property that somebody has 1031 their whole life, I guess.
Yep.
And then when you inherit it, you don't pay any capital gains on that? Or if it's...
No, it's the estate. So the estate would, if you're under the federal estate tax exemption, there would be no federal estate tax to pay, and then the heirs are going to receive what's called a step-up in basis on the property, and that step-up in basis will be the value of the property the year of the death.
How does it actually then work? I mean, I know that you have to identify a property within a certain amount of time. You have to close in a certain amount of time. Walk us through those steps.
Okay. So in most scenarios, somebody calls in and they have a rental property and they bought it 10 years ago, and they purchased it for, let's say, $250,000, and today it's worth $500,000. Okay. So we have a $250,000 taxable gain. There's typically some depreciation recapture that's allocated in there, but we won't muddy this up with that. They decide, yes, I want to do a 1031 exchange because we intend to buy a replacement property. We'd like to reinvest that $500,000 into something else.
Okay.
So at that point, the realtor calls us and says, what do we need to do? And it's pretty easy. I mean, we just need to open a 1031 account with a company like Pioneer 1031 Company. And then we work directly with the agent and their escrow officer. So we're going to work with the escrow officer who's closing escrow on the sale, and we get a copy of the purchase and sale agreement and the title commitment. And once we have those two documents, we can generate what we like to call the Phase 1 exchange package. We put those documents back in escrow. We redeposit them with the escrow officer with instruction as to what to do with them. And then at closing, the seller basically signs standard closing documents in addition to the 1031 exchange amount. What happens legally in an exchange is the seller is giving the accommodator, giving Pioneer 1031 Company an assignment of their rights in the purchase and sale agreement, because the taxpayer can't touch the money. If the taxpayer touches the money, it's taxable. So they give an assignment of their rights in the purchase and sale agreement, which a seller at closing is typically entitled to money. So all they're doing is giving the accommodator an assignment of their right to receive proceeds. So when it closes, the funds don't go to the taxpayer, it goes to the accommodator, and at that point your clock starts to run. And the taxpayer is going to have 45 days to identify replacement property, and they're going to have a total of 180 days from day one to successfully close escrow on the purchase of replacement property.
And it has to, and each one of those days is a calendar day.
Calendar
right?
day.
It's
If it
not
falls on a weekend or holiday, then you better get your homework done the preceding
Beforehand.
Friday.
So, and can you do it the other way around? Can you do a reverse exchange? Can you buy a property and then sell?
You can. So a reverse exchange in a frothy market like what we've seen as of late, a reverse exchange allows my clients to shop first. So selling something historically over the last couple of years hasn't been difficult.
Right.
Finding the right replacement property at a number that interests
the
you
challenge.
is the challenge. And so a reverse exchange allows you to shop first. So you can sit around and wait, and then when the right opportunity presents itself, you move on it. In a reverse exchange, you can put it under contract, but at closing, the taxpayer cannot take title to the replacement property.
Okay.
So the taxpayer is not going to be the buyer. The accommodator becomes the buyer. So in a reverse scenario, we actually end up holding title to property for the benefit of our clients. Reverses are great, but you have to think about how we're going to pay for it.
Right.
If you don't have the equity out of the old property, does the taxpayer have the financial wherewithal to purchase the new property first? And that's unique to them. If they have cash on hand, reverses are great. If they can get it financed, reverses can be great. But if they have to have the equity out of the old property in order to pay for the cost of the new property, it's never going to work. So the reverse exchange agreement is kind of the framework for everybody's rights and remedies, but our entity that ends up taking title to this property, first of all, our clients are very important to us, and so we like to protect their interests. So, if Ben were to do a reverse exchange and we're buying a $400,000 replacement property and you have the funds to do it, you're going to deposit those funds in escrow to be used for that purchase. It's not going to go directly to my company. The escrow officer will use them to pay off the seller. The seller deeds the property to the accommodator, so we're going to form an LLC that's going to hold title. And then our LLC is going to protect our client by providing them a promissory note secured by a deed of trust. So Ben's the lender.
Oh, wow.
You loaned us $400,000, we're taking title to a property. Now that just bought you 180 days to successfully list and sell and close on a relinquished property. While we're in title, we also are going to give you a zero rent triple net lease. So you're going to have possessory rights in the property, and you can sublet it and collect rents and everything. So yes, legally we have the indicia of ownership, but you also have a possessory interest pursuant to the leasehold.
A couple questions that I was thinking when you were saying that. You have 45 days to identify a property.
Correct.
We're going back to the normal exchange here.
Yep.
Let's say you want to sell and then buy. 45 days to identify the property you're going to buy from the day of closing.
Correct.
Can you identify more than one property? Let's say you're not sure. It's either one of these three or one of these six. Can you do something like that?
You can. There's a couple of different ways that taxpayers can identify. The first rule is called the 3-property rule, and that's very easy. You get 3 properties.
And you don't have to buy all 3?
You do not. Just because you identify it doesn't mean you have to purchase it. It just leaves the option for you that could be a property that will qualify within the 1031 exchange. So 3 properties of any value. We don't care how much they're worth. You just are limited to 3, and these need to be identified with reasonable particularity, right? It needs to be an address, a legal description. You can't say 20 acres in Idaho, right? That exists everywhere. So it needs to be a specific property. If somebody needs to or wants to diversify and they intend to buy lots of replacement property, maybe they're selling a large commercial complex for millions of dollars, but they want to diversify and buy some single family rental and some office and commercial and industrial. The 3 property rule isn't going to work because they want to buy more than 3. So they fall under what's called the 200% rule, and this is the other rule you can identify under. The 200% rule allows you to identify as many properties as you want, but you're limited to the fair market value of what you identify.
Okay.
So if you identify 10 properties, each worth $100,000, that is $1 million worth of value, aggregate value, and that's what we're limited to. So if you sell for $500,000, you can identify up to $1 million, which is 200%.
Okay.
200% of what you sold is what you can identify. And those are the 2 rules that are primarily used in the 1031 exchange process.
And is that a pretty easy process? I mean, you don't have to give a contract, obviously, because you haven't made an offer probably yet. It's just
It's a simple
literally
form.
it's a form you write an address on.
Yep. So our company, when the exchange comes to life, then we generate some forms and we send off an identification form. The only party that sees it is going to be the taxpayer, maybe their agent, and our company. And that form's required by the IRS, so we have it. But it doesn't mean that the properties are under contract. I do recommend agents that are involved in a 1031 exchange don't just identify property and then go back and try to negotiate on them. Start making offers during the 45-day identification period. Make all your offers and then tie up what you want. And once you know what it is you're going to purchase, then we identify it.
What if the property you're buying is a little less than the market value of your property that you sold?
Then you'll pay tax on the difference, but only on the difference.
And that's called a boot, right? The boot.
Yeah. If you trade down in value, if you need to reinvest $400,000 to completely defer all your tax liability, but you only reinvest $360,000 in a replacement property, there's $40,000 of boot that you'd have to pay tax on. So your tax liability would be limited to just that $40,000 amount, and boot is either cash that you didn't reinvest, or it's debt that you relieved yourself of. That's called mortgage boot. So if you had a mortgage on the old property and you have a mortgage on the new property, but it's $40,000 less than what the old mortgage was, that's mortgage boot. Just like either way, you're trading down in value,
going down,
and a dollar is a dollar to the IRS, whether it's cash or mortgage. In terms of common misunderstandings in an exchange, a lot of taxpayers have heard the term a like-kind exchange. Sometimes you hear that used in the industry. So it's misleading, because if somebody has a single-family rental and they hear the term like-kind exchange, they think they have to buy another single-family rental. And it's not nearly that restrictive. It's incredibly broad. You could sell a single-family rental and buy any interest in real property other than a primary residence or a second home. So that's the biggest misconception, is the use of the term like-kind and what the consumer thinks that means. Another common misconception is that when you do an exchange, you only have to reinvest your gain. So for instance, if somebody bought a property for $250,000 and they sell it today, years later, for $500,000, they think, I have a $250,000 gain or profit, and that's all I need to reinvest in a 1031 exchange. And that's not true. The IRS has this wonderful tax deferral scenario in place, but in order to get the benefit of it, you need to roll your original investment plus your gain. So your original $250,000 purchase price plus your $250,000 of gain is what they really want you to reinvest into a replacement property. Hence the boot. So if you trade down in value, if you don't spend all of that, then you pay tax on what you didn't reinvest.
That makes sense.
That's probably one of the biggest misconceptions. And some of the time periods, a lot of people think that you can just re-identify any time. So on day 60 of the exchange, I don't want to buy any of the 3 I identified. Another one came about, I want to purchase it. And you can't. You can't re-identify beyond your 45-day period.
So if you don't buy the one that you've identified within 45 days,
identify it within 45 days.
Let's say you identify one, but it ends up that you don't get that house because they didn't take your bid.
Or you backed out for any number of reasons.
The 180 days don't matter anymore because you haven't identified the one that you're going to buy.
Correct.
And you're going to pay tax on that.
If you only identified one property and you choose not to buy it for whatever reason, or can't buy it for whatever reason, and you're on day 60, your exchange is over, and you're going to get a refund of all your 1031 proceeds, and at that point in time, it's taxable.
Yeah. Thank you so much for watching, and a special thanks to Jesse. Really great content. If you haven't seen his thoughts on what's in store in the Boise housing market moving forward, check out this video right here.